So we'll dive into the outlook here for oil and gas, coming from work from our firm here. In terms of, again, for those of you who are coming back to the forum, you'll probably see that you know what our format looks like, but hoping to leave everybody with 6 key insights here. So just very quickly, right? I mean, oil seems to be in a happy place, although the world is not quite in the same place. I saw some data out there that there haven't been as many conflicts around the world at this point of time since the Second World War, but oil prices obviously hasn't gotten the memo yet. We don't expect a whole lot of change in the oil price here going forward. Natural gas is oversupplied, and it doesn't seem to remember 2022. So that's another interesting dynamic. In fact, if you're in the natural gas business today, it's a pretty tough year that you're bracing for. There are some growth opportunities in midstream, but fairly limited. U.S. refining, I think Tim spoke very well about this, gave us an overview, but the party seems to be over. But still, I left the conversation with Tim thinking that, diesel cracks still are at a reasonable place, so that's a good thing. Oil and gas capex, we think will grow, but it will grow slowly. A lot of this is also because of pretty high levels of efficiency that we are seeing across the oil and gas value chain. And then finally, just to wrap it up, right, the US is now a net energy exporter. Terrific growth story from an energy exports point of view. But is there more to that story? So we'll keep going for now, but then let's see, we'll try to get these fixed up here. So let's start with a picture of global demand, right? Basically, if you have been tracking oil demand for the last 4 or 5 years, right, the general consensus is that it's been growing at about 1.5% a year. Last couple of years, actually, growth has been much higher. So we anticipate some sort of a similar demand, but probably some moderation going forward. So we expect a little short of 2% growth here over the next couple of years. The broad story generally has been a migration of oil demand growth towards emerging markets, but we are really seeing that now. And when we say emerging markets, we are really talking about emerging markets without China and India. We are now seeing oil demand actually slowing down in China and India as well, and the bulk of the demand growth is really coming from other parts of the emerging market. So we are clearly seeing some shift in the locus of energy demand growth more towards Middle East, Africa, Southeast Asia, and Latin America. So we just talked about demand. If you now look at supply, right, what we are seeing is on the supply side, we are seeing most of the supply growth really come outside of OPEC+. US obviously will continue to grow. We had a terrific growth year from a US light tight oil production point of view, as well as NGLs last year, but we'll expect similar, not similar, but some growth from the US as well going forward. And that'll be coupled with additional growth that we expect from Guyana and Brazil, essentially deep water oil supply. So those are the 2 big tranches of growth that we expect here going forward. There will be some growth in OPEC+, but a lot of that growth is essentially coming from a relaxation of the cuts that have been made in oil supply over the last, I'd say, year or so, right? OPEC Plus surprised us with the cut in April 2023, so we expect some of that to be relaxed here in the back end of 2024. But broadly speaking, right, essentially a non-OPEC Plus growth story here from an oil supply point of view. US supply has been interesting, right? I think we came in last year and said that we expect some growth, but it is going to be limited and modest here. But then US shale came and put 2 million barrels per day of total liquids growth, including NGLs last year. So that has been that has been quite surprising, and we'll talk about that a little bit. But the primary driver of that was there was a pretty large DUC inventory, essentially inventory of wells that have been drilled but not completed. And the US shale industry ran through them a lot more quickly. So we've seen a lot of growth here in the last year or so. We obviously don't see that going forward. In fact, if you look at our forecast, we are just expecting another 100 to a couple 100,000 barrels of additional crude oil production. There'll be some more NGL production, so the liquids number will be higher. But just light tight oil, crude oil production here in the US, we think that 2024 is going to be a slow year. So so that was on the supply side, right? I mean, so if you break this down, and we're going to have a much richer conversation here in an hour, or not in an hour, but maybe in 30 minutes or so, with our upstream onshore panel. We have a couple of producers who will be here, but so we're expecting that to be a fairly interesting conversation. But really, I mean, this is not new, but essentially this is a growth story. This is a Permian growth story all the way, right? I mean, in fact, if you look at if you look at all the other plays, right, Permian is essentially taking share from the rest of the plays, right? So it's all about Permian, that where we expect the bulk of the growth here going through 2030. Now, what is interesting though is that if you look at Permian a little bit more closely and look at Delaware versus Midland, right, you'll see that Delaware is actually 33% higher productivity from an IP point of view than all the other plays, but that number is falling, right? So I think that's the piece that's a little bit more concerning, and broadly speaking, this kind of reflects the general consensus that shale is probably maturing, and going forward, finding and sustaining these kinds of growth rates that we have seen over the last few years is going to get challenging. Midland, on the other hand, has better completion intensities in terms of effectiveness, has a higher oil cut, so therefore they have fewer barrels of water coming out of their wells. They also seem to have better well construction with the ability to do longer laterals and things like that. But then if you look at some of the other plays, Eagle Ford and Bakken, for example, very sharp decline rates, and those are some areas that are of concern. So going forward, right, I mean, we don't really see big supply challenges for oil. We see sufficient supply even from even outside OPEC. That coupled with the fact that US has emerged as such a large supplier of oil and is a lot more stable politically, we don't seem to see a big impact in terms of oil pricing, irrespective of the broader conflicts, for example, that we are seeing right now. So broadly speaking, we expect oil price to be in the 70s. Usually every year we kind of identify some upside risks and some downside risks associated with oil price. We really struggle to put this page here together because we don't really see what is going to impact oil prices here, given that we've had a couple of fairly interesting years and yet oil prices seem to be reasonably stable. But if you see a further slowdown in China, oil prices could fall. If, let's say, the US continues to have this production surge that we saw last year, probably oil prices may fall a little bit more. There's limited room for OPEC to cut back more on oil supply. So therefore, the real wild card here is what happens to US production growth. And then if the soft landing that everybody seems to have gotten comfortable with turns out to be a little rockier or harder than expected, then obviously that'll have a pretty big impact in bringing oil prices down. In terms of things that could raise oil prices, obviously if OPEC Plus decides to keep its cuts all the way through 2024, that could be supportive. If some of these conflicts in the Middle East expand and Iranian supply gets impacted, that probably could have an upside on oil price. If for whatever reason we continue to misread economic signals and these markets grow faster, that could have an impact as well. Natural gas. So natural gas production Actually, since the pandemic had a slightly modest year last year, we didn't quite see a big growth in natural gas production. If you look at the growth, for example, between 2021 and 2022, that was a big jump, but we didn't quite see that from 22 to 23. Going forward, we are actually a little bit more bullish than the market in terms of natural gas production growth. I worry that we'll probably be wrong here, but that's where our thinking is today, mainly because of what's happening in terms of natural gas prices. It's not really in the interest of producers to produce more, and the demand picture, as I'll show you here, is looking bleak as well. The share of associated gas production isn't really changing. A lot of the associated gas production economics are independent of gas price. They really depend on oil prices. So one glimmer of hope is that oil prices stay low, and that will disincentivize some of the associated gas production as well. But I think we'll kind of have to see how this all shakes out. In terms of where we expect additional growth in gas production, we're going to see some gas production growth in Appalachia and Permian, the large shale plays, but Haynesville is the star here, right? I mean, 40% of gas production growth over the last few years has come from Haynesville. We expect that to continue. Haynesville is in close proximity to a lot of the LNG export terminals, and that continues to be supportive. Broadly speaking, we look at this chart every year and the chart doesn't change, right? Which is that we have substantial amount of natural gas in the US. A lot of that can be produced at less than $4 an MCF. So if you can do things with natural gas, US is the place to be. The problem is that there's not a whole lot that you can do with natural gas other than seemingly exporting it, right? Which is what we're trying to show here. So this is showing what is the demand growth that we can expect in natural gas over the next few years. And you can see that first stack there, LNG exports, that's really the bulk of the demand growth that we expect over the next few years. So building out these LNG export terminals and exporting LNGs is the primary driver. There's potentially some exports via pipeline, primarily into Mexico, where we see additional coal to gas switching, and if that comes through, there is additional growth via pipeline exports. The interesting number here is power, right? We see almost no growth in natural gas power generation here in the US, and a lot of the coal to gas switching story has kind of run its course. So essentially that, and if you look at what has happened historically, this is a chart that shows gas demand in different end-use markets. The top two are residential and commercial markets. The bottom left is industrial. So if you look at residential and commercial markets, we've actually seen declining use of natural gas, primarily because a lot of these end-use sectors have become very, very efficient. And new build tends to consume a lot less gas than, let's say, the existing assets that are being replaced. If you look at industrial gas demand, which is the bottom left, that's where we have seen some growth, and we actually expect that number to grow far more significantly in the next few years, primarily because there's a massive manufacturing boom that is underway, that the US is seeing right now. But if you look at the bottom right, that is gas demand for power generation, and that's really carried the weight for a lot of gas demand growth here in the US in the last few years. But now if you look at that number again on the left, right, we think that story has run its course, and we don't expect additional gas demand growth here. So that kind of puts, again, all our baskets from a gas demand growth point of view in and around LNG, and to a certain extent, pipeline exports. So given that this pause on permitting new exports to non-FTA countries by the Biden administration is quite worrisome, right? Because it has suddenly put into risk about 10% of global LNG demand by 2030 into risk, right? if you start building an LNG project today and you start seeking a permit to export that to non-FTA countries today, that capacity is going to hit the water only in about 2030 or so. So therefore, looking at how much of capacity today is at risk because of this pause in permitting exports, in terms of what demand will look like in 2030 kind of tells you, right? Constraining any market by 10% of its demand is going to have a pretty big impact on LNG prices. And what that will do is not necessarily just raise LNG prices, it will incentivize a lot of other energy technologies, whether it is solar, wind, and so on and so forth. So we think that roughly about 11, 12 BCFD of gas production is impacted right now because of this pause by the Biden administration. But if you think about like what is that going to do, right? First and foremost, we think it's going to benefit existing exporters already, right? The Cheniers, Freeports, Venture Globals, I think they already have capacity in place, and they are probably going to be more advantaged. A lot of these companies are also developing their own projects, and those are at risk as well, but at the same time it does help existing producers. We do think that if Biden is re-elected, there will be just greater scrutiny of this. We do think that this pause will go away because the impact of LNG on the broader economic story is too large to be ignored, but we do think that that will result in much greater scrutiny of the GHG footprint and emission profiles of the broader natural gas and LNG value chain, right? So if you're in the business of helping gas producers reduce fugitive emissions, GHG emissions, this is a good thing for you. But it also what's more challenging is that this also advantages LNG capacity outside the US, right? Whether it's in Mozambique, Papua New Guinea, or some of these other places where you're trying to develop LNG export capacity, right? It advantages some of these other countries as well. And then finally, of course, the natural gas value chain has work to do in terms of reducing its GHG footprint, especially around methane fugitive emissions, and some of that is potentially going to get accelerated. This is a view of new LNG capacity that is coming on stream over the next few years. We see a big slug here in 2024. We do think that this probably is overestimating things right now based on the fact that some of these projects are getting delayed. But what we are looking at is purely from a startup point of view. If you monitor the LNG world closely, you know that startup and actually exporting cargoes to meet your contractual commitments are now two different things. But from a startup point of view, we see quite a bit of North American LNG capacity coming on stream in the next few years. Going forward, we think LNG prices will kind of revert back to the historical averages that we have seen, somewhere around $12 to $20 a million BTU. So the orange and the blue lines are Asian and European pricing and we have the forecast on the far right. The dashed blue line is European futures, which are trading more about $8 an MCF or so. So in some ways, the futures markets don't quite agree with our forecast. And what that tells you is that traders believe that there is sufficient LNG that can clear the market if and when there is a need for those LNG cargoes in Europe. So going forward, we expect natural gas to be sub $3 here through 2024. If you talk to traders today, they'll tell you that I'm being optimistic. They expect prices to be actually sub $2. But if we take a slightly longer term view, we think that it should kind of on average get to about a little short of $3 or so, and then it just rises a little bit in 2025 to $3.25. Again, in terms of what could potentially raise natural gas prices, let's say there's a quick resolution of this pause on LNG exports, that helps the sentiment. It doesn't really bring more volumes onto the market, but it does help sentiment. If we are underestimating this manufacturing boom, then it's much larger, and that drives up industrial gas demand. That could be supportive. And otherwise, it's just weather, right? I mean, if we run into difficult weather at the end of the year, then that helps gas prices. We see more downside risks, obviously, around natural gas pricing, right? Further reductions in LNG exports, whether it's because of a plant issue or whether it is because of a broader reduction in LNG gas markets, that'll have an impact. If renewable capacity additions continue to accelerate, especially because of IRA incentives, that'll have a negative impact on gas pricing. And then if this gas oil price differential continues to widen, we're going to see more production coming out of Permian, which means we're going to see more associated gas production, which means you're going to see some further reduction in gas prices. So let's take a look at midstream, right? Obviously, we are well past the days of that great big infrastructure build out around midstream, but there are still some interesting opportunities. If you take crude oil, we think that new pipeline capacity coming out of the Permian is still required, probably not right away, maybe at the end of the year, but there's some growth opportunity there. Natural gas, I think, two main areas. One is you can see some opportunities for new pipeline capacity coming out of the Permian, potentially some exports, some pipeline to export into Mexico, and then finally some pipeline capacity to debottleneck some of the movement of natural gas towards some of these LNG export projects. NGLs, we're going to have an excellent panel on NGLs later this afternoon. We do think that probably the US has room for some additional NGL fractionation capacity. NGL production has been growing very rapidly over the last few years, and a lot of that has to be really exported, right? There's fairly limited growth opportunity here for propane, some growth opportunity for ethane, but we are kind of exhausting some of that. So essentially you have to export a lot of that LPG, which means that you need some new LPG export facilities. And then some small growth opportunities here and there around gathering and processing infrastructure, in particular around Haynesville, which, as I said, has accounted for a significant amount of growth capacity for gas supply growth recently. I just talked about NGLs, a lot of growth here, a lot of that obviously coming from the Permian. Now, if you compare that to the existing LPG export infrastructure, which is the chart on the left, you'll see that we are essentially running very close to effective export capacity. So essentially, we need new LPG export capacity. There are a couple of projects that have been proposed. We expect them to come on stream here over the next few years, so that will allow us to kind of export additional volumes of LPG. Crude oil pipeline capacity into the export terminals is also getting close to capacity, so I think there's additional room and opportunity to add additional pipeline capacities to export out of the Corpus Christi terminal. So let's talk a little bit about refining. Tim has set us well for this discussion here. The chart on the left shows crack spreads, blended US-wide crack spreads. So you'll see that big spike for 2022 and 2023. These are not diesel cracks. Tim was referring to diesel cracks. These are more 3-to-1 cracks. So these reflect both gasoline and diesel sales. So it's a little bit lower than the $70 number that he was citing for diesel cracks. But broadly speaking, right, I mean, multiple factors driving this. First, I think, although there has been an increase in refining capacity utilization, product balances have been very tight, and that has accounted for some of these high spreads. Some of that is getting resolved, and we expect some moderation here going forward. Broadly speaking, if you break this down by region, which is the chart on the left, we expect some sort of a reversion to the historical mean in all the paths, except for the West Coast, where we still see some elevated crack spreads, at least for the next few years. Of course, West Coast is now is a very different refining market relative to the rest of the world, rest of the US, in the sense that it has very increasingly stringent regulatory requirements around fuels, but also because fuel capacity, refining capacity is getting constrained. And so we expect some sort of elevated crack spreads that will prevail in the West Coast market over the next few years. We talked about this a little bit in the discussion with Tim, but this is a big issue right now, which is the differential between light and heavy crude oil. This impacts the competitiveness of US Gulf Coast refining capacity because it depends very heavily on heavy crude oil coming in. Canada now has additional pipeline capacity that is being built that will move heavy oil onto the West Coast, the Trans Mountain Pipeline, and this is going to have some impact on this differential between light and heavy crude oil prices. So this is one thing to keep an eye on. This pipeline has weathered a significant number of delays and challenges from a regulatory point of view. To a large extent, most of these have been resolved. They are now essentially struggling with construction issues, but broadly speaking, we expect this to be completed here. This will make it more difficult for US Gulf Coast refiners to compete for these heavy oil barrels, and some of these barrels are likely to be exported back into the Asian market from the west side from the west side in Canada. So I think this is another big trend here. So what do US Gulf Coast refiners do, right? I mean, they continue to export more volumes into Latin America. Latin America is where a lot of US refined products are have been ending up over the last few years. We expect this trend to continue. We have a couple cases on the left and the right, but essentially somewhere somewhere around 1.5 million barrels per day of refined products are essentially being exported into Latin American markets. A lot of Latin American refining capacity continues to struggle with low utilization rates. Once some of that starts getting resolved, that will have a pretty significant impact on these exports. But right now, we anticipate exports into Latin American markets to continue over the next few years. We do obviously a lot of work here, and that's just a commercial there for some of our work there. Tim touched on this a little bit in his conversation about retail, fuel retailing markets becoming very expensive to access. Some of this is because all the large refiners and all the large majors are going and reacquiring fuel retailing assets. When I started my career in the oil and gas industry in the early 2000s, all the oil majors were selling fuel retailing assets because they didn't have the right levels of return. But in a market that is where returns have come down quite a bit, and where growth and accumulating your returns comes from small incremental progress across the value chain, fuel retailing has become interesting again. So Shell has acquired some assets, BP has acquired some assets. A lot of them are paying very high valuations for some of these assets, but also some of the independent refiners, Marathon, Phillips 66. Phillips 66 has in some of their recent calls talked about how they are making investments in that last mile fueling infrastructure in order to increase returns on wholesale, branded, as well as retail fuel margins, because all of that matters when your returns are compressed in other parts of the value chain. Super active M&A market, which is what we are reflecting on the right side in broader fuel distribution and logistics. There's a lot of interest in a lot of markets trying to source CNG, LNG, and we're going to have a great discussion on this here, the LNG panel, primarily around small scale LNG. Primarily, and the big driver here is really energy transition, right? So a lot of end-use markets that, for example, depend on diesel-fired backup power or are using other high carbon intensity sources want to now access fuels that have a much lower carbon intensity, and therefore that is driving some of the interest in this last mile fuel distribution and logistics space. So I'm running a bit short on time, so I'll accelerate, but I know that a lot of the people here are interested in what's happening to oil and gas capex here. So this is a view of global upstream capex. We expect some growth, but it's going to be limited. A lot of this capex is now being deployed in a couple of places where we see the big growth. Obviously, U.S. light tight oil, U.S. shale will continue to grow, but also deep water, right? A lot of production from deep water is going to grow. Those are two segments where we see 30 to 60% growth in supply through 2030. In comparison, if you take a look at some of the other markets, conventional and even unconventional gas, we expect that to be somewhat steady and maybe even decline a little bit in the later years. We don't expect great growth in capex, primarily because a lot of the value chain in the broader oil and gas space is getting very, very efficient. So this is a view of break-even prices for gas, unconventional gas. And you can see that there was a little bit of an uptick last year, which is the blue band there. And the orange line there is Henry Hub gas pricing. Because of oil field services and supply chain inflation, there was a little bit of an uptick there in break-even costs, but that has come down, and in fact, some of the players, the costs have fallen quite a bit more. We have a similar situation with light tight oil as well, continues to get more and more competitive by reducing costs, break-even costs. And so essentially, right, the value chain is getting a lot more efficient. Consolidation's the other driver because, and we're probably going to talk a little bit more about this in the next onshore panel here, but there's been a lot of consolidation in the upstream space, and with consolidation, you're going to see a lot more cost-effective capital spend program relative to, let's say, multiple companies operating in these plays. There are multiple drivers for this consolidation. I won't go through that. There'll be probably an interesting discussion here. But a couple of interesting points, right? Now we are finally getting to the point where the Permian acreage is starting to look like a lot less fragmented here. So what we are showing here on the left is the share of Permian acreage owned by different stakeholders, right? Different types of operators. So you'll see that at the top we have the oil majors who have essentially doubled their ownership of Permian acreage in the last couple of years. Some of the big acquisitions, ExxonMobil buying Pioneer, for example, have been responsible for this. What is interesting is the chunk that is owned by private equity, right? So that's the orange-yellow stack there, and that has fallen by almost 2/3, right? So essentially, the amount of acreage that's out there that is owned by private equity firms and therefore is available for M&A conceptually, that stack is declining, right? So you could argue that this is another driver that we see around capital spending becoming a lot more efficient. If you are an oilfield service company, right, and you start to think about like, okay, with capital spending kind of growths, moderating or stagnating, where are the opportunities? I think the opportunities are in helping onshore unconventional operators get more productivity out of their assets, right? So what we have is a chart on the left here that shows productivity as reflected by 6-month cumulative oil production here on a barrel of oil equivalent per foot basis, and you'll see that those bars are kind of stagnating, right? In comparison, if you look at the bars for 2016 to 19, significant growth there, but that growth is now stagnating. You could argue, depending on who you're talking to, that some of that is also declining, but we see that more as a stagnation in productivity levels. A lot of the shale operators have done a remarkable job of taking existing wells and improving their well construction, whether it is through longer laterals or improving completion intensity by using more proppants and things, using more proppant and things like that. And to a certain extent, we have seen innovation in and around production operations. But to a large extent, over the last decade or so, a lot of the innovation has been restricted in and around wells, right? The next tranche of innovation, if you want to keep raising these productivity levels, will have to occur in different areas. And operators will have to start thinking about innovation in a lot broader sense. So if you go and talk to EOG, for example, they'll tell you how they have used seismic technology to discover a new gas play that has differentiated break-even costs relative to other similar plays in the region. So that's one example of innovation that we don't quite expect coming out of the shale patch. And then, of course, ExxonMobil is talking about how they want to improve recovery factor. So it's not just well production per well, but it's actually well production per foot of a lateral, for example. And some of those are very challenging problems that the industry will have to work through. So very quickly, right, the US is now a net energy exporter. You pick any commodity, natural gas, obviously we know well from the LNG growth story, crude oil, even coal, right? I mean, it's a little bit more choppy, but we are seeing the US export a lot of energy. Similar story in refined products, in NGLs, and even in biofuels, right? When renewable fuel standard was first proposed, everybody talked about how corn-based ethanol was not cost competitive to sugarcane-based ethanol. But the U.S. today exports almost 75% of all of its ethanol exports into Brazil. So essentially, corn-based ethanol today is more cost competitive than sugarcane-based ethanol, mainly because the capacity that has been built over the last couple of decades has found ways to reduce costs and make ethanol production a lot more competitive. So it's a terrific story and kind of shows both the absolute and comparative advantages that the US energy enterprise has in terms of producing energy. So that's one part of the story. But the other part of the story is what it has done to CO2 emissions. So this chart on the left here shows the natural gas production in the blue bars, and it shows the red line, which is CO2 emissions, right? So we've essentially decreased CO2 emissions since the beginning of the shale boom by about 20% or so, right? So in other words, I think that's the piece that is not well understood by a lot of people, right? And that kind of reinforces what the true value proposition is for a lot of the US energy industry. And this kind of aligns well with what is trying to be accomplished, for example, from a climate change point of view. So we've identified just a couple of the outcomes from COP28 on the right, whether it is recognizing the need of natural gas, for example, for energy security, or finding ways to make the existing infrastructure a lot more cleaner by reducing methane emissions. So I think it's putting these two stories together along with the broader export story, right? That's the value proposition of the US energy industry that's probably not well understood. So let me pause there, see if there are questions. Otherwise, we'll go into the break. We're running a couple minutes behind, but...
Morning, Uday. Carol Economist with Horizon Consulting. Just a couple questions on this last slide that you showed. I just wanted to clarify if it's if that was CO2 or CO2e, which would factor in methane.
No, it's not CO2e, it's CO2 only.
Okay. And the other question is, Do you have any comments on the renewable natural gas play and whether renewable natural gas supply has increased significantly and if it will become, a significant part of our supply over the next 10 years?
Yeah, I think RNG supply has definitely increased, right? It's still a very small fraction of the overall supply. But all the incentives are in place in terms of seeing more supply come to the market, right? But it'll still always be a very small fraction of the overall market. I think that's a quick headline there. We have actually 2 people from the RNG industry on a panel tomorrow on Energy Transition Day, so we'll probably have more chance to kind of dig deeper into some of that.